This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. So it's been a tough start for 2022. A little more than 2 months through the year, and the S&P 500 is on the edge of correction territory. On Friday, March 4th, the index closed 9.2% below where we ended 2021. It was expected this year we'd finally be able to get past the impact of the pandemic. Consumers are in great shape. Household income is at record levels. Unemployment's fallen back below 4%, and corporate profits hit all-time highs in 2021. Based on these positive fundamentals, stocks also hit new highs, with the S&P 500 gaining 27% over the year before. But now there seems to be several factors clouding the positive outlook for stocks this year. The first is inflation. For the last 4 months, inflation has been running at greater than 6% over the prior year. In fact, inflation started to accelerate last April. The increase in prices was initially thought by the Federal Reserve to be due almost exclusively to shortages caused by supply chain disruptions. The pandemic, with its waves of infection, periodically shutting down manufacturing. The global supply chain has enabled the efficient manufacture and distribution of products around the world. But the pandemic showed just how fragile product supply chains can be. One missing microchip from Asia can shut down an entire auto plant in the Midwest. The primary tool the Federal Reserve has to manage inflation is to raise interest rates. The problem with raising interest rates is it increases the cost to borrow money and slows down economic growth. Unchecked, inflation will cause significant harm to the economy. The trade-off for slower economic growth is generally worth it, but there is a cost in slower growth, which translates into reduced corporate earnings. And then Russia invaded Ukraine. Putting aside the heartbreaking humanitarian crisis for a moment, the economic impact globally will only further exacerbate inflation. The war in Ukraine seems poised to get worse, and additional sanctions, including Russia's energy sector, may be coming. Those will be expensive, although worth the cost in our view. With the inflation pressures, rates will have to come up. Inflation and higher rates and geopolitical risks and sanctions and higher labor costs, they're all real concerns, especially when you consider that investors started the year with a very optimistic outlook, meaning stocks are expensive unless economic growth and earnings expectations can be met or even better exceeded. We now think that's unlikely in 2022. The market's increasingly forecasting a tougher road ahead. One sign of this revised expectation shows up in the yield curve. The yield curve refers to the higher interest rates that are paid for debt as the duration gets further out. So, for example, a 3-month Treasury bond has little risk. The likelihood of an adverse effect materially affecting the value of the bond in the next 3 months is pretty low. So the current yield is a low, right now, 0.35%. A 2-year Treasury bond has a bit more risk, and investors want to be compensated for the 2-year duration. The current yield is higher at 1.44%. As you can see on the graph, the yield steepens initially and then levels off a bit in the middle. The curve currently is very flat by historical standards. There is little difference in yield between a 2-year and 10-year bond. With the expectation that rates will be rising this year due to inflation, the short maturities have increased quickly since the start of the year. At the same time, investors are becoming concerned about the strength of the economy, resulting in comparatively lower long-term rates. Rates in the near term need to be higher to fight inflation, and that with slower growth, rates further out will have to be lower to spur economic growth. This is what is referred to as the flattening of the yield curve. Here's a plot of the yield for the 10-year Treasury and the 2-year Treasury since 2004. Notice just before the 2008 recession, the spread, the difference between the two maturities, was practically zero. Currently, the spread between the 10-year and the 2-year is only 0.24%. The yield curve has gotten rather flat. The yield curve doesn't really predict what the economy will do any more than betting odds for a football game will tell you who will win. The odds don't determine what will happen in the game, but they do reflect what people are willing to pay based on expected outcomes. Like sporting event odds, people are voting with their dollars, and there are a lot of smart people participating in the market. It's fair to say that the expectations for the economy are moving lower. This is not to say that a recession is imminent, but it is apparent that investors are increasingly concerned. Recession or not, the yield curve says the market is anticipating slower growth coupled with higher inflation. The yield curve can be a good gauge of economic expectations. Stocks are valued based on earnings and future earnings forecasts. So changes in earnings estimates are more directly tied to stock market performance. Of course, poor economic growth or a recession will broadly impact earnings. So all these data points are really interrelated. We've talked about earnings expectations quite a bit in the past. Expected corporate earnings, they're still positive this year and next, with growth of 8.7% in 2022 and 9.5% forecast in 2023. The expectations come from the analysts that publish estimates for each of the companies they track. The problem with earnings expectations is they are usually revised downward after the economy is apparently slowing. Here's a chart of the revisions made by analysts in the first 2 months after the end of a quarter. You can see the massive downward revision due to the initial economic shutdowns from COVID in the second quarter of 2020. Since then, analysts have had to consistently revise their estimates upward due to the unexpected strength of the rebound in the economy, at least until now. In the first 2 months of this year, the earnings expectations for the first quarter were reduced by 1.2%. This is not a material amount by itself, but the concern is that suddenly there are increasing risks to earnings. Inflation, labor costs, uncertainty around what will happen with the invasion of Ukraine. Sanctions may end up including energy, food, and commodities, further exacerbating inflation, particularly in Europe. And this will impact global economic growth. The conflict is also further disrupting supply chains, which still have not fully recovered from the pandemic. Not every sector of the economy is being revised equally. High energy prices are benefiting the energy sector. Earnings estimates for energy companies have been revised almost 15% higher, and that's pushed energy stocks up 35% this year. Earnings are going to drive stock prices. It is interesting to note that although real estate and technology have had slight increases in earnings estimates, stocks in those two sectors are down. This is due to rising interest rates. In the case of real estate, increased borrowing costs will eat into profits, and for technology, high growth and high price to earnings multiples are both impacted by rising rates. We continually try to assess the likelihood of various economic scenarios in the management of client portfolios. Outcomes based on the data become more or less likely as the data shifts. So far this year, the risks are adding up. Based on the current earnings forecast, we're still positive on stocks and think that the market will likely end the year higher than where we're at today. But looking at the yield curve and earnings, inflation, and the war in Ukraine, the risks of a recession, or at least slower growth, are increasing. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports to your inbox. Thank you for watching.